There are many pitfalls to investing money. Let's discuss a few of the more popular ones. Modern portfolio theory, or also referred to as MPT. Modern portfolio theory is just a simple assumption that there is a constant efficiencies in the market. And I will go through some examples that the market was highly inefficient. One of the most popular investment strategies working toward retirement or in retirement are mutual funds. A diversified bucket of various stocks within various sectors of the market, all put together in a pie chart. So again, it's very diversified, it's optimized, it's allocated. You can actually be over-diversified to the point of mediocrity. At Strong Tower Wealth Management, we prefer to own only 30 to 40 individual stock positions within your account. That again is the key that sets us apart from other companies. When you came in to look at an investment firm or an advisor and you were looking at a proposal and they showed you 3 different models, either conservative, moderate, or aggressive. Keep in mind that the only difference between those 3 models is that one has a higher fixed income or bond allocation than the rest. Your conservative portfolio, say, is roughly 40% bonds. Your moderate is 20% bonds, and the aggressive is 10% or possibly even 0% bonds. The point is that allocation model helped you determine what model that you wanted your money invested in. Well, keep in mind, interest rates have been at an all-time low since 2008, so bonds aren't even keeping up with the rate of inflation. Strong Tower does not own bond funds. We are in equities or cash. Also, there's interest rate risk with bond funds. Well, what does that mean? Well, to keep it simple, interest rates operate on a teeter-totter. As rates have fallen, bond prices have appreciated. So the value of your bonds in your portfolio have probably shown a gain. As rates rise, the value of those bonds will decline. So the idea of being more diversified or allocated or maybe a more conservative portfolio by owning bonds can still be at risk because it's actually losing money while your equity portion of your portfolio is trying to make you money. Let's discuss bond funds. The drawback to owning bonds is the fact that they're not even paying enough to keep up the rate of inflation, but yet they're considered less risky. But keep in mind that bonds work on a teeter-totter, and we are at historically lower interest rates right now. And if rates rise, and inflation may determine that, but if rates were to rise, your bond funds actually lose money. So my point is, while it may be considered diversified, while it may be optimized and it may be appropriate based upon your risk tolerance, the bond allocation can actually be costing you money or performance when you're trying to make money on the equity side. Are you truly aware of the risk associated with your bond funds or fixed income investments within your portfolio? Target date funds. Other options that I have run across in retirement planning are target date funds. The perception of less risk with your money being allocated more toward bonds as you get closer to retirement than in equities. Strong Tower Wealth Management does not own target date funds. The only determination of a client regarding a target date fund is their age, nothing else. Another pitfall of my industry is lack of appropriate exit strategies within your portfolio. Have you ever noticed on your statement that you may have a few positions, maybe 1 or 2, that are really underperforming and underperforming very poorly? Why do you still own them? Why have they not been sold or replaced with something else? What kind of exit strategy do you have for the investments that are not working out? Let's discuss non-correlated assets. Well, non-correlated means that they're not related to each other. And if one area of the market does well, the other areas of the pie chart or that allocation don't do as well. In your typical asset allocation model of mutual funds, you're going to have equities, bonds, or fixed income, and you're going to have international and commodities, maybe even some currency exposure. The point is, it is a broad-based approach with a little bit of everything. So the problem with non-correlated assets is that in times of increased market volatility, those non-correlated assets become correlated and in an exponential fashion. So in times of extreme downside volatility, when you need it most, that allocation strategy will fail you also. So if a decline in the market's happening in clusters and they're closer together, it would stand to reason that you may be able to be defensive, raise cash, do something in the account to lower the risk in your portfolio. So let's talk about risk tolerance. Now stay with me here. Whenever you go in to meet with an advisor, you're asked what's your risk tolerance. You're probably asked to fill out a risk tolerance questionnaire. For example, if you were to be asked, Mr. Jones, are you okay with a 10% upside performance? Well, yes, I am. Then, Mr. Jones, you're okay with a negative 10% downside performance? Well, no, I'm not. So we go from a moderate allocation, we're going to suggest a conservative allocation. Okay. Mr. Jones, are you okay with a 5% upside performance? Yes. So you're okay with a 5% downside performance? Yes, I am. The risk tolerance questionnaire is nothing more than a way for the firm and the advisor to cover theirself if things don't work out. Because think about this. You filling out that risk tolerance questionnaire, you doing a risk assessment, you've basically determined what you're okay with as far as your performance. You have made the decision. And because of that, they'll always be able to go back and bring that up that you were okay with this, Mr. Jones, when we first started working together. The average rate of return for the last 10 years of the S&P has been 13.6%. That's considerably higher than the 5% that you agreed to be comfortable with. So if you were to bring that up to your advisor and you're not happy with the performance, well, Mr. Jones, you selected that because that's what you were comfortable with. So when you completed the risk tolerance questionnaire or assessment, you, as the client, determined your performance or what you were going to be comfortable with. Do you have any idea how much return you may have left on the table for the last 10 years? Let's discuss rebalancing. Well, what is rebalancing? Rebalancing happens when a client brings money into a firm and that money is rebalanced or allocated to a particular model. Well, Strong Tower Wealth Management does not believe in rebalancing. Why? It depends on the level of the markets. Now stay with me on this. If the markets are elevated or overbought or reaching all-time highs, why would you want to put your money in fully invested, rebalanced at the top of the market? We don't think you should. We don't rebalance to the model regardless of market conditions. We deploy your money very specifically depending on those market levels and conditions. Also, if you're getting a rebalanced strategy or you're being rebalanced to the market, you're getting nothing specialized. Again, your money is going in and buying these stocks or these mutual funds that have been in a bull market for 10 years at elevated levels. At Strong Tower, we determine what the overall risk factor is in the markets. And if we determine that the markets are a little overbought, then we're going to be conservatively putting your money in at that market. And we're deploying your money individually. Eventually, yes, you will look like everyone else in the model over time, but on the front end, your money is deployed very specifically, either aggressively at the bottoms or conservatively at the top. What's your investment strategy?